When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio number 22. Sorry about that. I had a mic wire my way there. This is going to be a show focused on history, focused on the markets, focused on the Fed, and a little bit of an ode to someone I had the honor of interviewing back in 2007, I believe it was, about what has been happening with our treasury market. There's a lot of things that people don't see under the surface, and a lot of people who aren't paying attention to what's happening under the surface. There's games being played. Damn near could call it money laundering, for lack of a better term. The markets are just now starting to settle. I will sit there and get that market data out to you in just a minute. I think you will be shocked to hear that there was a sudden story at the last minute to try and juice the markets up. I know that's hard to believe. Unbelievable that they would do that. And of course, it was that Qualcomm was looking at taking over Intel. The usual Friday afternoon during options expiration, quadruple witching, no less, attempting to sit there and make sure we didn't have a down day today. With the market starting to settle, I can tell you right now, the one market that has impressed me more than anything else is gold. And we'll get into that discussion a little bit also, because this was, without a doubt, one of the most bizarre weeks in market and economic history as far as what happened, why it happened, and where it's going. We've had a lot of interventionism in our markets, be it Treasury, be it the commodities markets, the stock market, of course, and naturally everything else that follows, because we are seeing a government that is desperate to win re-election. We're seeing a Federal Reserve that is desperate for the markets to have a continuity of the existing policies, which I would call corrupt cronyism capitalism. No other phrase for it. The reason I say that is that this is not how you're supposed to run a railroad. It's terrible what they have done to distort free market will and what they're willing to go to as far as preventing actual bid and ask from being processed to sit there and reflect the demands of the people. It's not a normal situation for inflation to be high or above quote unquote target, as the Fed likes to say, and then suddenly say, well, we got to cut rates because we think there could be possibly an economic slowdown, but we're not sure because the data we're depending on is corrupted. I will say what we've seen in the past 72 hours is absolutely astonishing, and I do mean astonishing. I'm going to read something real quick from the raw transcript of the press conference with one Jay Powell, and it is an astonishing statement to kick this show off, and then we'll go through the market data, hit some news and store highlights, and then bring on some of our MacroEdge team, because we've got a lot to talk about what happened this week, and it is a kind of news flow that will blow your mind. Mr. Powell actually said this, and this is I'm going to include all the ums and everything else, so it sounds like it's natural, just like the transcript said before it was cleaned up. Starting with QCEW report, which suggests that maybe, well, that not maybe, but suggests that the payroll report numbers that we're getting may be artificially high and will be revised and will be revised down. That we've seen an anecdotal data like the Beige Book, and so we talk about all of these those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So in other words, they have been making years worth of multi-trillion-dollar decisions based on data that the chairman of the Federal Reserve on Wednesday afternoon admitted was a defective measure of economic strength for employment and payrolls. If that doesn't catch your attention, I'm sorry, I really don't know what else I can do to help you, because trillions of dollars literally flow on the words and actions of these people. And here we are now having an admission by the most powerful central banker of the world saying, we're making decisions on bad data, which means that the government has been making decisions on bad data or has been deliberately producing this bad data to generate an outcome that is favorable to their desired targets. The markets today just closed. I'm going to just sit there and give you the quick summary as of a few minutes ago. Dow was up 36.66. Well, maybe not. I just got to update it. Up 38.17 to close at 42.063. S&P down 10.76 to 57.0288. NASDAQ down 62.93 to 17.951. The VIX didn't do much of anything. They got it below 20. They kept it below 20. It's at 16.09 to finish the week. Dollar index at 100.47. It was on its way. It broke down to 99. And then the Japanese got a phone call from the Fed and said, hey, we're going to cut rates, so you better not do anything to screw this up. And the yen, of course, rebounded back after kissing 139 to close the week at around 143.90. Gold up 31.95 today to finish the week at 26.4605. An impressive run for gold this week. And on a side note, Costco, according to Gold Telegraph, has been selling close to $200 million a month in bars and coins. And I've seen them. They're nice 1 ounce Walking Liberty gold coins, and they're very nice bars. If you can get them when they post them up on their website as a Costco member, it's not much above the market price that we're seeing quoted on our Quotrons and our various services. So, folks, it's not a bad deal. Silver up 3 cents to 31.35. They have better deals on silver when you can get the rolls of 20. Trust me on that one. I've witnessed that myself. Moving on to other news. The Fed made their cut on Wednesday. Why is that such a big deal? Well, it was a 50 basis point cut. For those of you who want to be non-snobbish or technical, it's 0.50%. They did the same thing on September 18th, 2007. So September 18th, 2007, September 18th, 2024. The difference is in 2007, there was no evidence of a building financial crisis except to those of us who were paying attention to it, reading the various financial reports, the alternative media of that era, and also paying attention to what was going on in the markets. We knew there was a problem. That's how I got into the radio business. That's how I became a part of this discussion. And that's when I started generating a blog online to sit there and offer my 2 cents from a historian. I was in the construction industry at the time as a supplier and managing logistics for a regional distribution company. Took care of building materials, etc. And I got to talk to the customers. I got to talk to the vendors. I got to talk to everyone in the industry. And I found out real quick that when I have vendors coming up to me and bragging about owning 3 houses on Longboat Key, and for those of you who don't know, that's one of the wealthier spots in Florida. And I said, well, how did you do it? Well, I did the 0 down routine. I knew we were going to have a disaster. Well, what's happening this time that we could parallel that to? The Airbnb bust is the closest thing that we could find an analysis to. We have people who actually took out credit card loans to get a down payment on a house that they thought they could rent out that would cover the nut, aka the cost of owning that house on a weekly basis during peak season, and hopefully find some people to come down and visit Florida as suckers, live and take care of the house for them, take care of our payment, give them a minimum rate in the summertime, high rate during peak season. Not a big deal. Well, that's starting to blow up in everybody's face. A lot of communities are banning Airbnbs. The county I live in, Sarasota, being one of them. Everyone's had enough of this. Everyone's tired of seeing it. Airbnb didn't police themselves until it was too late, and it's becoming a blight on the various communities. Individuals are beginning to understand that their investments are falling short, and we're starting to see personal bankruptcies because, believe it or not, in a lot of these cases, they went in as sole proprietors. They did not incorporate. They did not set up LLCs. They said, well, they can't take my home away from me in Florida, their primary homestead. So let's go ahead, set this up and say, I'm going to have 3 homes for vacation rentals and I'll have no problem. And that'll pay my personal mortgage plus everything else. We're starting to see the unwind as interest rates have stayed higher for longer. And also the fact that our real estate market is beginning to slow down and they're going to have a hard time dealing with that issue. The interesting thing about the move was also last night, the discount rate window was knocked down 50 basis points from 5.5 to 5% with a secondary rate of 6%. That is one of the reasons that we're starting to hear some noise. The banks needed this break. They needed a lower overnight discount rate so they can begin to take out loans. And I know you're finding this hard to believe, to try and start refinancing this commercial real estate. The prime CRE or commercial real estate is not a problem, folks. It's the garbage, the 50% empty buildings, the absolutely ridiculous hotels built in parts of town and the country that nobody would want to stay at. Nobody in their right mind would want to stay in some of these places. And yet they went ahead and made speculative investments, gambling that the people who created these projects or purchased these buildings knew what they were doing. The return to work idea, the return to office theme blew up in their face. And in fact, San Francisco is paying a huge price with well over 25% vacancy rates. Seattle, Portland, you're starting to hear the stories creep in. While New York is not taking the beating as bad as many other locations, we're starting to see the consequences of a change in how America is run at the corporate level and how people are dealing with it. And that is going to filter down to Main Street. 2's 10s, one of my favorite measures. It's our, as you know, if you've been reading MacroEdge via Ozone, and that's macroedge.net/Ozone. Go there to subscribe for a 2-week free trial. We've been pounding the inverted yield curve for a long time, and this is the longest inversion of the yield curve since, dare I say it, 1929. That should wake some people up. But now, does that mean we're going to have a 1929 style crash? No one knows. But the conditions might be getting closer and closer to that. And we're going to have a discussion with Six, our investors, one of our MacroEdge team, to talk about that, and some of our other team members, because this is a situation that people are not expecting. Nobody expected 1929. But if you look at the history of what the Fed was doing into it, you see some ominous parallels. And you also see how the speculation was allowed to run rampant and go crazy. The 2's 10s is disinverted. It went from a positive 0.25% on Wednesday when Powell started speaking and closed this week at a positive 0.14%. That's a pretty substantial move in the bond market. And if people do not understand that, you'll have to sit there and read the history on this. In fact, in 2007-8, when it disinverted, it skyrocketed fast. Same for the 2000 era and on and on and on. You can see it in the charts. It starts off slow, skyrockets higher. That disinversion is a signal, especially if we roll into a recession. And a lot of the indicators seem to say that we will have a recession, and this recession might be a long and nasty one. As I've stated, my personal opinion and analysis, John Galt, FLA, says, hey, I think we're going to have cyclical stagflationary recession. I think it will last for a decade. It will be akin to something from the 70s, where they have inflationary periods that will have stagnation, zero growth, or negative or contraction of 1 to 3%. Now, these could be 6 month, 3 month, 9 month, who knows? But I think the setup for that is the fact that the Federal Reserve has to suppress interest rates to finance the massive government deficits. Lower rates are necessary. If they don't engage in that, you could see this blow up quite easily. And it won't take much to push our interest rates higher on the long end. What the Fed did on Wednesday will probably push long duration bonds to higher yields in the long term. Short term, which is what we've been using to finance because Janet Mushrooms Yellen insisted on issuing T-bills and 1 and 2 year notes to ridiculous excess, has actually made things worse, causing the rollovers to occur at a faster pace. That will impact Main Street and availability of funds and liquidity for the regular soul. Now, one thing about what's happened with the Federal Reserve that they don't talk about on the bubble visions, as I like to call them, yeah, I'm old, there's a lot of discussion in the Fed of what's been going on. Now, one of the things I suggested that was that because of the August 5th crash, there was going to be some hint or direct action to cut the discount window rate. Well, from Reuters, I missed this story, but then again, I've had a lot on my mind lately. August 27th, Michael Derby was the reporter. Members of the board of directors overseeing the Chicago and New York Federal Reserve banks voted in favor of lowering by a 0.25 percentage point the central bank's discount rate during July, according to meeting minutes released on Tuesday. The Fed said in a press release that while 12 regional Fed banks wanted to maintain the discount rate at 5.5 in votes taken last month, the Chicago and New York Fed directors wanted that borrowing rate to move down to 5.25%. Why is that critical? Those are your two financial centers. That is where your banks are. That is where a lot of the trading occurs. Somebody knows something about problems. And that is where we're going to go into the Treasury market. A discussion came up on X, FinTwit, as it's called, financial Twitter. The X now, I can't get used to calling it X. It's always going to be Twitter to me because, one, I'm old, and two, that's what I'm used to dealing with. It was something that Luke Groman said, and it caught everybody by surprise. He noticed it. Everyone else has been noticing it. I just happened to catch it because it was a subject that was near and dear to my heart all the way back in 2005 and in 2007. And the posting seemed innocent enough. But Kathleen Tyson, another person you should follow on Twitter, that's at Kathleen _Tyson_, where she stated something is broke in the matrix when Cayman Islands, which are hedge funds, are the principal buyers of U.S. Treasuries while everyone else is selling. This is not normal TIC data. Well, I've quit following the TIC data because I figured it's about as fraudulent as you can get. But I'm going to tell you right now, the American people have been under the impression that we're running a non-rigged game, that there's no way that we would sit there and engage in chicanery. I love using that word. Sorry, it's reality. The truth is that there was this belief there's this huge banking center in the Cayman Islands that takes care of drug money, hedge fund money, and everything else. Basically, it's a wall of P.O. boxes. And there's very little mail in those post office boxes, folks. And a great individual, as one of the people I learned a lot about this from, Rob Kirby, wrote an article on March 19th, 2005. And there's a link through my blog. You can get to it if you type his name in. Pirates of the Caribbean. People seem to think that it was a little dodgy. And back in 2005, it wasn't called Cayman Islands. It was called Caribbean Banks. And it was the gross total of all the islands' banks. Now, I'm going to break that down for you in the modern parlance and what the TIC report says now, so you'll understand how this is being played. Quote, net long-term security flows. Net foreign purchases of both domestic and foreign long-term securities from U.S. residents was $91.5 billion in January, compared with $60.7 billion in December. Now, you hear those numbers and you think, wow, that's nothing. Those are low numbers. But here's the part you have to ask. From Rob's article, with such being the case, here's the somewhat simplistic, but I would argue accurate depiction as to what has happened to these friendly and extremely generous Caribbean-based hedge funds in the past month and a half. 10-year 4% coupon government bond in the month of January yielding 4% at par, price of 100. Same bond in March with a yield of 4.5%, price of 96.03, 4% loss. Now remember, hedge funds typically employ leverage when they invest. $10 invest for every $1 in equity is perhaps a conservative measure in assessing leverage employed by hedge funds engaged in the bond trade. You can use LTCM, by the way, as a well-documented benchmark. They had roughly 100 to 1 while playing in Russian bond market. So using this conservative metric of 10 to 1, anyone can see in the past 6 weeks alone, hedge fund losses on their acquisition of $23 billion in additional U.S. debt has resulted in losses in the neighborhood of 40% of the principal allocated to acquire the position. In such a case, that would represent nothing short of a mortal body blow to their capital invested in these bonds. If such were the case, this would surely be front page news in the mainstream financial press now, wouldn't it? But we all know this is not the case, since nothing to this effect has been widely reported or even underreported in our responsible mainstream financial press. Fast forward to 2022, when I wrote an article, an ode to Rob Kirby after he passed away, Pirates of the Caribbean, a Bad Powell production remake. Now, he's a sound money thinker, so I have a little bit of a bias. And at that time period, I do have that TIC chart from that. But if you look at what was being reported on the major foreign holders in Treasury securities, the TIC report, in January of 2022, this would be the March 2022 report, by the way, the Cayman Islands held $271.1 billion worth of U.S. Treasuries. 271.1. In my soon-to-be cigar nicotine-stained fingers, I printed the current table, summary of the largest TIC holdings, major foreign holders. The Cayman Islands now holds $378.1 billion of U.S. Treasuries, allegedly. Keeping in mind that the Cayman Islands as a nation only has a GDP of $6.8 billion as of 2022, you begin to ask questions. You understand China. You understand Japan, the United Kingdom. Hell, I even understand the island of Jersey holding dozens of millions of dollars worth of treasuries. But then you start reviewing some of the minor players in the quote-unquote Caribbean island chain. British Virgin Islands, $39.85 billion. GDP of $1.02 billion. Barbados, $1.53 billion. GDP of $5.7 billion. Trinidad and Tobago, one of the more destitute island nations and also one of the more corrupt. $5.7 billion GDP. I mean, a $30 billion GDP holding $2.44 billion worth of U.S. treasuries. The Bahamas, $7.47 billion in U.S. Treasury holdings, $12.9 billion in GDP. And let's just quit picking on the Caribbean islands. Let's go to Mauritius. Now, many people are going to say, where the hell's Mauritius? It's one of my bucket list places to go to. It's a beautiful island. It's a mother of a flight. $952 million worth of U.S. Treasuries on a $12.95 billion GDP. It's become one of the offshore banking paradises for the Arab nations, India, China, and, of course, the United States players, hedge funds, etc., as a conduit. What you have to ask is, if they can take these kind of losses on U.S. Treasuries, what are they doing with those holdings? And who are the hedge funds that are doing this? Well, I've simplified this in the past where you simply pick the phone up and say, I'm going to call this hedge fund in the Caribbean because I can use it as a tax shelter, and I'm going to send them $10 million because that's the minimum you have to be a player in this kind of stuff. And I want to sit there and invest it in bonds or something safe with a stable return. They say, no problem, Mr. Galt, we got you covered there. Let's take care of that. Well, basically what that is a shell hedge fund for the New York banks in many cases, or other overseas entities. And we use that to shuffle the losses off the books of our main players in New York and Chicago, wherever in the United States, stick it down there and resell it, repackage it as garbage to other overseas buyers. It's a conduit. And the buyer of last resort, of course, is the Federal Reserve. So if a bond is losing, a group of bonds are losing holding power inside that Caribbean group of bonds structured in that thing, the tranches that are losing money can be resold to Citigroup or JP Morgan or Goldman. The Fed will take it on and then force the Treasury to take it back. The losses will be sit there and passed on to the taxpayer. It's a long process. But I suggest you read Rob Kirby's article. And I think that you all need to understand that the political situation that forces these kind of games means that we're not playing on a level playing field. All of you people who are playing on Robinhood or even Think or Swim, it's not that we're equal. They know they're superior. They know they can move markets. And remember, 60+% of all trades are not on what you're seeing on your screen. They're dark pools. They're private trades. They're outside of what CNBC and Fox Business and Bloomberg reports. So the prices you're seeing are what they want you to see, and they push it up or they push it down. It's when everybody panics, when the linchpin is pulled, that we see the real crisis, and it's coming soon because that bill has to be paid. With that being said, I don't know if Six is ready to join us after my rant. I am going to sit there and bring in an opinion to counter something I wrote this week, because I thought yesterday, after looking at the numbers, that we had reached a blow off top, in my opinion. Now, I'm not, invest at your own risk. There's a disclaimer that will come out of the pre-recorded portion of this program. I am not a financial advisor, certified financial advisor of any type. Your mileage might vary. But I looked at the patterns, and I saw a spinning top yesterday. That's candlestick trading, folks. And I've seen it throughout history. And I think this could have been the blow-off top. We may not be done rising, but Six, let me know if I'm half crazy. Historically, when you see a spinning top into a weak uptrend on low volume, that's not a good indicator, is it?
No, it's not a great indicator. Hey, John, how you doing?
Pretty good. I had to get that rant about the Caribbean bond fraud out of my system, of course.
You feeling better?
I'll take a sip and I'll let you know afterwards.
All right, buddy. Yeah, this was an interesting week. I was thinking after the Fed meeting that might have been the end, but of course they ramped it up the next day to a new high. I'm not sure the indices are going to stop rising until we get some weaker labor data. Gold keeps going crazy. I think that's because the Fed has kind of made it clear that they're targeting labor and not inflation. So, I mean, I keep looking at the Chinese reports. The Chinese are still buying gold like crazy. I'm sure many other central banks are as well. Volatility, the VIX at 16 is starting to get interesting to me again. I kind of want to start buying some volatility again, because I think this is a good place to do it. I think we're kind of I don't have a ton of conviction on anything in the market right now, to be honest. Kind of just want to wait to see what the next few reports are looking like. I have some puts for June on the NASDAQ. Might add to those and extend the maturities of those as well. But honestly, I don't really know what to make of this. A 50 cut to start off, that's not what I would think the market would want to see. I mean, of course they love rate cuts, but what was interesting to me during the FOMC was how two different reporters asked Powell about the tendency of unemployment to keep rising once it starts rising, and he really didn't answer the question either time he was asked that, and I thought that was pretty important. You got a lot of uhs and ums from him when he was trying to answer that and dance around it. I don't think it's going to be great going forward. Don't know how much longer it's going to be until more deterioration happens in the indices, but I think more bad labor reports would do it.
What do you make of the breakdown today? I don't know if you had a chance to look at what happened in the markets, but in the transports, the trucking index basically collapsed. It was a terrible day today. Old Dominion down 5% plus, JB Hunt down. It was across the board sell off, and many of the major trucking companies following the FedEx news, of course, and also in the energy complex. Those are not positive indicators for a future growth spurt in the economy, in my opinion.
No, they're not. When transports are looking weak, that's never a good sign for stocks ever.
I mean, it's crazy. I'm not a big advocate of it, but Dow theory, et cetera, you're not
Right.
a big advocate of that, are you? I'm just curious.
I mean, it's something that I watch and I added into, a multitude of other things, but I would agree with that. If transports aren't doing well, then, I mean, that's the real economy, not the software and tech where all the big companies are selling each other software packages. I mean, even though that might make up a large part of the index, that's not a good reflection of how U.S. companies are doing. So, I mean, I think transports is a much better indication of that than tech. Tech's obviously going to do the best when everything's going well. And it might be even the last to show poor earnings out of all of the companies because, I mean, their biggest clients are each other instead of, actual consumers in many cases. But, yeah.
What is your play on the bond market? And in my opinion, staying short duration, staying something that's liquid that can be dumped as soon as possible, 30, 90, et cetera. How do you feel about that? I think it's a very uncomfortable position as a trader or an investor to find yourself in that you could see a deterioration in the long end and see your principal dissolve if the Fed continues to press the 100 basis point cuts they're talking about by December, or in some cases, you're hearing the banks pressing for more.
Yeah, I think so. We've talked about this extensively, but we were long 2-year note futures for a while. That was probably the best position I had this year. I got out of it now. I left some on the table, but that's okay with me. It's just not it's obviously a very safe place to be, but actually owning the underlying, not the futures. I wouldn't long the futures here. But I mean, it's just moved so much in the direction. I don't see a ton of opportunity to make gains there. Sure, to hold it and have it be, a liquid, safe yield, that's fine. Bonds, I feel like bonds are going to do whatever the labor market's going to do. I think that, any kind of labor market scare is going to override any other concerns about fiscal spending. I think they're going to scramble to buy bonds if there's actual fear about a recession. I think recession fear would probably trump anything else in the bond market. But that's also taken into account, is inflation really done or not? You had Waller today talking about how inflation may be coming down too fast. And then I wonder what it's going to look like if we start seeing some negative month over month core PCE readings. I think right now they have it projected for 14 basis points month over month for next week.
I believe that's correct. Yeah.
Yeah. I mean, that could some negative CPI numbers would also, in my opinion, have a slightly less effect than some really bad employment numbers, but I do think it would be a similar effect because then the growth rebound would be called into question because I mean you can't really have negative CPI and high growth. I don't really see those going hand in hand.
I 110% agree. Plus, I also believe that we're starting to see some of us who've been believers in the idea that we've been in a recession since April or May of this year. There's more and more evidence coming forth. And folks, this is not something crazy. Most people didn't recognize the recession in 2007 until after the fact. And everyone says Wall Street is predictive, but if you look at the market behavior throughout 2007, I think you'll agree with this, there wasn't a lot of conviction that the economy was in trouble. It wasn't until we saw Bear Stearns fall and more of the larger banks, the bank failures really start to furball, that people realize there was a major problem with the economy.
Yeah, and I mean, we talked about this the other day, but in leading into the 2008 crash, GDP, I believe, real GDP was at 3.8%. Right now it's at 3. There's not a set in stone set of data each time to be able to really know exactly where you're at. And right now we're at 3% real GDP, but strip out the federal deficit spending and how does that look, and the federal deficit spending is not evenly making its way through all the different sectors of the economy. It has different concentrations of where it goes. A lot of it goes to I'll obviously have Social Security, which is a little bit more evenly distributed, but then you also have defense, you have healthcare, and a lot of those are very concentrated on where that money is going and who it benefits. It definitely is a tough cocktail, and a lot of people get it wrong, and some people get it right. And I think we might be in a recession right now. I would probably agree with that.
Very good, sir. And real quick, if you'd like to sit there and promote the Vision Fund and talk about MacroEdge.net, please go right ahead.
Yeah, sure. We're in a drawdown on Vision right now. Got out of our yen long near the bottom at the low 140s on USD JPY. I'm proud of that one. We held our ES short up from the local bottom here recently up to the max loss that we hit. Our ES calls took us out of that. Not proud of that one. That brought our P&L from April 3rd down to 37.752%. We were at 46% for a little while, so we're in about a 9% drawdown. Not proud of that one, but we'll get it back.
Fantastic. And folks, if you want to read more about what's happening, go to MacroEdge.net, subscribe to MacroEdge.net/Ozone, get your 2-week free trial. 6, I appreciate your input because I have the funny feeling we're going to be talking a lot about the markets the next 4 weeks.
I would agree.
All right, sir. Have a good evening. Kalani, welcome aboard, sir.
Hey, John, can you hear me?
You sound fantastic, sir. Welcome aboard. You have been in the muck. We're still hearing the cheerleaders promote the idea that everything is beautiful and there's no risk and we're all in great shape. Just buy more Apple, buy more stuff. Then they have the guy standing outside of the Apple store in New York City saying it's the worst lines he's ever seen since he started covering one of their new product debuts. At what point on the floor do people really start taking notice and saying, we better start hedging out because the consumer is looking weak?
That's a really good question, John. I don't have the answer. Some of the stuff that I've seen this week is just baffling to me. You mentioned, Apple stores, but just some of the commentary on FinTwit is just astounding, to be honest with you. I mean, we're talking about information or data being shared by, really prominent accounts and people with a lot of followers that there's just misinformation everywhere. And I don't know, I have this like really demented sense of responsibility to try to point out to less savvy investors where the errors are. And I take some punches online, but it's okay. I got broad shoulders, but it's getting worse, not better, the misinformation I'm seeing on a regular basis.
I'm not going to question that at all because the misinformation has been nothing short of a nightmare, in my opinion. I think you're 110% correct on that because of how it's been happening and what's been said. We're seeing breakdowns in the restaurant industry. We're seeing breakdowns in transportation, the commercial real estate problem. And I think retail is starting to show its hand, minus the Big Lots bankruptcy. But we're starting to see a lot of weakness in retailers, and Amazon laying off people before the Christmas season or cutting out contractors and cutting the contracts and laying them off. I find that disturbing and unusual. Your take, please.
Absolutely. I think that was in California, if I'm not mistaken, and I think it was about 300 warehouse employees.
Yes.
That's where we are right before the holidays. That's amazing to me. That says a lot without saying anything. But you mentioned the retail sales numbers, and there was a lot of hoopla. Oh, retail monthly sales numbers were up 0.1% a few days ago. Looking at August, and it's just amazing to me again that so few people look under the hood, because when you look under the hood, categories like food services, autos, general merchandise, groceries, furniture, gasoline, clothing, were all down month over month. And then the other thing that frustrates me about just general intelligence is people don't adjust for inflation. If you look at retail sales inflation adjusted, it's actually down. It was actually down 14 basis points month over month, and year over year, 0.45%. So the growth story doesn't hold any water. You still there?
Sorry about that. The mic button got stuck on me there. Yeah, this is live radio, folks. There's no playing around it. Every now and then you hit the wrong button and something happens. And with X spaces, God knows what happens. What we're seeing occur on that aspect of it, most people discount and say, "Oh, look at the retail sale numbers. You're so correct, sir." The problem that I see with that is that it's like the employment data. People are taking that to the bank, making investment decisions, and then deciding all of a sudden that we have to make life-changing on an individual basis, monetary investment changes, et cetera, and it's all wrong. It's all based on bad data. And the revisionism that we're seeing from our government data is something that should terrify everyone, absolutely everyone. And if people aren't paying attention to what's happening across the border in Canada, they're damn near into a deep recession, if not heading towards a depression, with the contraction they're witnessing across the board in all of their industries.
There are signs everywhere. I mean, couple of examples. Bankruptcy filings spiked in August. They took a little breather in July, but they're back up in August. Conference board leading economic indicators declined 0.2% in August. That triggered another recession signal. People don't realize that's been down 30 months. And we actually see prominent investment professionals touting that, or actually saying that maybe those signals are broken. They're not broken. I don't understand how someone can say that without actually acknowledging the fiscal policy and huge deficit spending, record setting deficit spending, offsetting some of these things. It's really cherry picking data from my perspective.
Exactly. And I think that is where we've come into a crisis. I think the whole thing that occurred with the Fed statement, and shoot a hole in it for me if you can. I think when the chair of the Fed admits the employment data is not a reliable measure of the economy, the chair of the Federal Reserve said that, then we have a problem with confidence. And our entire currency bond investing scheme is based on confidence, the confidence in the ability to pay it back, and the confidence that we'll keep the value of the currency at a set level where it's viable in global trade. And now we're starting to see our balance of trade and our just blow out because of the fiscal irresponsibility. When you lose that confidence, as someone who is in the investing game, that's not a great scenario to be in, is it?
No, not at all. I think there's a lot of misleading statements, whether you're talking about Powell or so-called investment professionals. I mean, it's ridiculous. You and Six were talking about labor, and Six was emphasizing how important upcoming labor reports are. I couldn't agree more. I think that's going to drive the coming months, and my guess is we're gonna see unemployment increase dramatically at some point.
I think you're correct, sir. I really do think you're correct. We have a guest who wants to join us. Empty Cup, please speak up. What's your question or comment, sir? Or ma'am? I'm sorry, I can't tell. Are you there?
Hey, how are you?
Pretty good, pretty good.
Where's the bond sell-off I was promised?
Looks like it happened in the 10-year, and the short end is still booming because it looks like we're heading towards a 352 year and a 4% 10-year.
It looks that way, but I'm saying, I mean, with this, the speed of it, how do we really measure it? Because what is it? Yeah, 3.741 right now. And if I'm looking at the back, at the last 3 months, if we're not over 3.8, should I really be impressed? I mean, I'm in general in agreement with everything you're saying, and all I can tell you from restaurant standpoint is I've been a chef for, chefing for 25 years, and as I put in the comment, we had same position, adjusted, same great rate. Year-over-year comparison from July was I had maybe 3 or 4 applicants last year over a 3-day period, as opposed to 65 applicants this year in July.
That's
so I haven't seen that. I haven't seen that kind of ever since COVID. A lot of people left this industry in general, and it was really a workers kind of market. And I wish that was the case when I was 20 something. Getting $20-something an hour. I mean, I was used to $14 an hour my whole life until I graduated to the chef level. But anyways, I'm just saying it's I haven't seen that since pre-COVID. Same thing, influx for concierge position was over 100 applicants inside of a week. Fucking crazy. People that were overqualified, people that were coming from outside of the the industry. Because there's usually a lot of people moving around industry to, within the industry, but just a dramatic, noticeable shift across the board. Bartenders, whatever you have.
Well, I promise you one thing. I can't guarantee there will be a sell-off in bonds that's going to be noticeable because usually it's a very gradual liquidation. If we suddenly see a 10-point move in the 10-year, though, that's pretty substantial. And what we witnessed during Wednesday was an 8 basis point move. That's pretty dramatic during a Federal Reserve Chairman press conference. Usually 1 or 2 that's it. But to see 8 basis point jump up in rates and blow out the 2s, 10s like that and the disinversion, that's pretty shocking.
I mean, wasn't that besides their political motivation, wasn't that their whole point? I mean, but we have mortgage rates that are, continuing to lower, it seems like, and I'm out of my depth here, but I'm trying to understand follow all of these things because they matter. These are the metrics that I'm kind of, looking for. Same thing, oil can't, unless oil breaks out here and it just seems to continuously fail to, it just seems like it's going to continue sliding back. You have what appears to be, deflationary pressures. Certainly in the commodity sector. I mean, yeah, sure, some of the softs have come back from the rate cuts, but I mean, how come FANG isn't ripping my face off right now? You just have it piling into still defensive stuff like utilities.
Hey, Empty Cup. This is Kalani.
Hey, man, how are you?
Good. Hey, I wanted to comment. I think you're looking at the right stuff. I think patience is going to be rewarded. I'd like to just remind listeners, we're 7 weeks away from an election.
Yeah.
They're holding things together. This is my opinion. They're holding things together with barbed wire and duct tape and whatever they can at this point. There's a lot of suppression and manipulation of data. That's my perception. I've been doing this quite a long time. So I think just, I think just you're looking at the right things and expecting to see the right things. And I think that you'll start seeing them very soon.
Yeah, I kind of expect that. I don't really I'm not really trying to press anything too hard because, I mean, you have coordinated efforts by all the central banks that seem to want to try and push down the dollar, and it seems like a bottom to me. I don't know, not my expertise, but there's no reason why the Bank of England wouldn't cut if it wasn't, other than political motivation. Like, am I wrong in that viewpoint?
Well, I'll speak for the Bank of England real quick. Bank of England has a major problem. They have to attract capital, and if they don't have higher interest rates, no one is going to buy into the garbage they're selling. They're running huge deficits, and they, honest to God, do not have as much ability to finance those deficits as the United States. And now, with the new liberal government, I would look for more labor issues over there, and not to mention the political issues. They can't even field their entire Navy any longer. And Lord Nelson is spinning in his grave. It is a disaster of a nation, and will become one of the it will become the basket case of the European region before this is all said and done. It'll be worse than Italy in the 70s.
And then let's go back and look to the Lagarde with not cutting when Germany's.
Oh, absolutely. Empty cup. You broke up on us there. We're gonna getting close to wrapping the show up, but to be honest, Lagarde, for some reason, thought that she could not cut. They've got to cut deeper because Germany's in dire trouble. This is the worst economic outlook for Germany in decades, and this could be a problem. And the headline just popped up. Thank you, MacroEdge. World economy faces pressure similar to the 1920 slump. It's that bad. Oh, we seem to... Empty cup, you seem to have gone into sell hell. I appreciate your input, and don't be a stranger because we like hearing about the restaurant industry. We have Kat B on occasion. She does sit there and contribute to the MacroEdge team. It is something to appreciate. Sir, have a good one. Can you hear me now? Empty, I seem to have lost you. I'm going to have to drop you off the list here. And we got one more person who wants to jump in. Old guy, a longtime reader of my blog and listener to the program. Welcome to MacroEdge Radio. Are you there? Nope, I guess not yet. There we go.
Wait, there we are. I'm here. Now I'm on. I just wanted to touch on the Canadian thing from where I'm at. I'm by two major points of entry for Ontario, and truck traffic is way down.
Is this
way down?
Is this inbound or both ways?
Both ways.
Yeah, I used to do a lot with the crossings in by Detroit and the Peace Bridge, so I know what you're talking about. So if it's way down, that's bad.
It's way down. I mean, usually Sunday, Wednesday, and Friday are their big days coming back, with them leaving Saturdays, Tuesdays, and Thursdays usually. And you don't see many of them coming across.
So without seeing that truck traffic, aren't those communities beginning to suffer? Because that was something that supported a lot of the truck stops, mechanics, etc. That's not going to be good for Buffalo in some aspects, at least from the transportation side.
No. And I've been talked to. I'm a retired driver, and I still have friends in the industry. I've talked to some of the people, and they say even truck stops are not as full as they used to be. So take that for what it's worth.
Sir, that's a great bit of indicator, and I appreciate that information. These little pieces of the puzzle, folks, are what makes the MacroEdge reporting a little different. We love these anecdotes because what that tells us are things you won't see in the mainstream media, and a lot of times you have to dig into the local newspapers, local broadcast media to hear the stories. If Joe's Garage lays off 15 mechanics, that's not a big deal to a CNBC. But if 1,000 Joe garages across the country lay off 15 mechanics each, it catches your attention that there's a problem, and there's a problem with the underlying economy. People need to start listening to stories like Old Guys and what Empty Cup reported. It's the kind of thing that gets your attention as we head into what I think is already a 4 or 5 month old recession. If we see this data starting to accumulate faster, and I watch the trucking industry too, Old Guy, as you know, I just can't see Canada doing very well should we have a deep recession in the United States. I just don't see them making it.
You're probably right. A lot of it is stuff coming up from Mexico and that. I don't see a lot of that happening either, because there's issues with their car manufacturing over there too. I've heard cuts and this and that, just local anecdote stuff. So we'll see. I keep an eye on it though.
Appreciate it, sir. And thank you for joining us. We're going to start preparing to wrap the show up.
Okay.
Thanks, Old Guy. Have a good one. We'll catch you on the other side. Old trucking talk, guys. You'd have to understand that. Kalani, anything else you'd like to add this evening? Oh, I guess not. I was hoping Kalani was there, but we can go from there. Folks, this has been one of the most interesting market eras, and for that headline to hit the Financial Times, world economy faces pressure similar to 1920 slump. Now, there's a story. Eugene White, Journal of Economic Perspectives, Volume 4, Number 2, Spring 1990, pages 67 through 83. The stock market boom and crash of 1929 revisited. I'm just going to read one paragraph to close the show up, because what it shows is that no matter how much we change things, there's still some things that sound the same except without the scratchy vinyl. The technological and structural changes in industry in the 1920s promised higher earnings and dividends. While those developments created a stock market boom, they also made fundamentals more difficult to evaluate. Sound familiar? Thus setting the stage for a bubble. The October panic can be traced to early signs of a recession that made the dissonance between dividends and stock prices clear. When panic selling began, intervention by the Federal Reserve Bank of New York prevented a collapse of the financial system. When you hear that, you think, well, that was then. Well, folks, in 1929, in August of 1929, there were individuals within the Federal Reserve System, there were economists, there were traders, there were people saying, we're in a recession, and this country is going to have a major problem when it turns the corner that they don't understand. Now, we didn't have the FDIC in 1929. We didn't have a lot of the geopolitical issues. But Herbert Hoover, for being the technocrat that he is, and yes, I have both editions of his memoirs on my bookshelf, that's how much of a geek I am, actually sat there and thought that the Smoot-Hawley tariffs wasn't the greatest idea in the world, but he signed it because of the overwhelming approval of the House and Senate. And they thought that would bring in the lost revenue, along with the problems that we're having with the gold trade and financing of that era. Well, what are we looking at right now? We have two candidates, both of which think that tariffs will be a good supplemental tax to sit there and offset the massive federal government deficits. And they're going to pick out and protect what industries they want to protect and not sit there and engage in free global trade. This is not good. This will not end well. This will be a major problem for the American people. And I'm hoping that they understand just how bad it will turn out if things do not straighten out in the near future. We're looking at issues that are far beyond the norm of what we've witnessed since 2008. It's not a housing crisis per se. It's not a financial crisis per se, but a little bit of each combining with geopolitical turmoil and domestic political turmoil and companies having trouble making payrolls is a formula for disaster. Folks, stay tuned to MacroEdge. MacroEdge.net/ozone. Get your 2-week free trial. MacroEdge.net/ozone access. Actually, I apologize. I've been giving it wrong all this time. Sorry about that, gang. But Ozone access, you can go to MacroEdge.net to click on it. You'll see the button. Make sure you stay tuned. We're looking to get some special guests back on now that we're getting back into our normal groove. This show will be up and ready to rock and roll as an MP3 for further listening, probably on Sunday night. For MacroEdge Radio, this is John Galt speaking. Good night, everyone.